For centuries, a fundamental truth has driven the engines of global commerce, built empires, and forged fortunes. A principle so potent, it's often whispered among the ultra-wealthy, yet hidden in plain sight from the rest of us. It's the secret to how banks make their billions, and it's the key to your financial freedom. Welcome. You've been told to save, to invest, to let your money sit and grow. But what if that conventional wisdom is incomplete? What if the very act of passively investing your capital is leaving countless opportunities and countless dollars on the table? Today, we're going to crack the code of uninterrupted wealth compounding. To show you how to leverage a concept so powerful, it's literally how commercial banks operate. This is about building your personal bank. Let's start with the undisputed king of wealth creation: compound interest. It's the engine. It's the magic. Einstein reportedly called it the eighth wonder of the world. But understanding what it is isn't enough. We need to understand how it's often sabotaged. As investor Charlie Munger famously put it, the first $100,000 is a bit. Why? Because in those crucial early years, the vast majority of your growth comes from your diligent saving, not your investment returns. Your capital base is small, so the compounding effect is barely a whisper. But here's the kicker: your 401k, your brokerage account, even your savings bond, they all force a critical trade-off. To truly harness compounding, you're told to relinquish control and liquidity. You must let your money sit for decades. This creates a bottleneck. Your capital is locked up, unable to be used for other opportunities without interrupting its growth. It can only do one job at a time, and that is a fundamental flaw. To truly beat the game, you need to understand its rules. Let's put common investment vehicles under the microscope: your stock portfolio, your CDS, your regular savings accounts. They're cornerstones, yes, but they share that critical flaw. The money has to sit. When you commit capital, you create an opportunity cost. It's locked up. You can't use it for a business opportunity, a down payment, or an emergency without either withdrawing it or going to an external lender. And then there's risk. Market volatility isn't just an inconvenience, it can reverse your compounding. It forces you to trade control and safety for the potential of higher returns. The system is designed for them to profit from your idle capital. Think about it. Banks advertise high-interest credit cards, not high-yield savings. Why? Because your idle capital becomes their raw material for profit. To win, we must master their playbook. This is where it gets revolutionary. To build wealth with maximum efficiency, you need to think like a bank. Banks don't let capital sit. They maximize its velocity and utility. Step 1, asset acquisition. They acquire our deposits. Our cash flow becomes their asset. Step 2, capital mobilization. They don't warehouse it. They lend it out for mortgages, car loans, credit cards. Our passive savings become their active interest-earning assets. Step 3. They lend the same pool of capital to multiple borrowers simultaneously. They earn multiple streams of interest from a single capital base, magnifying their returns exponentially. This isn't rocket science. It's a scalable principle, and it's how you can become a powerful financial asset for yourself. So, how do we replicate this banking blueprint? Not with a traditional savings account, but with a specific vehicle: dividend-paying whole life insurance. I know what you're thinking. Insurance. That's not an investment. But hear me out. When viewed as a strategic financial tool, it becomes the ideal operational chassis for your private banking system. A whole life policy has two parts: a death benefit and a cash value. The cash value is your savings engine. As you pay premiums, a portion builds this cash value, which grows at a guaranteed, compounded rate. This is the secure capital base for your personal bank. But here's the linchpin, the secret sauce, the policy loan. When you take a loan from your policy, you are not borrowing your own money. The insurance company lends you money from its general funds, using your cash value as collateral. This is crucial. Your own cash value stays intact, still earning interest, still compounding inside the policy. Your capital is now performing two jobs simultaneously. It's invested, and its collateral value has been mobilized as liquid capital for your use. This allows you to stack interest rates, just like a bank. You leverage your compounding cash value to secure a loan. You deploy those funds for a car, a business, an emergency. Meanwhile, your original capital continues its guaranteed, tax-deferred compounding journey within the policy. You're creating a personal line of credit, collateralized by your own growing asset. You've transformed from a passive saver into an active banker, capturing the financial benefits that would otherwise go to a commercial lender. But let's be crystal clear. This isn't a set-it-and-forget-it magic bullet. The efficacy of this personal banking strategy is entirely dependent on you. The biggest risk in this system isn't the policy. It's the policy holder. This requires active, responsible management. Number 1. Systematic repayment. You must treat policy loans with the same seriousness as a commercial loan. Pay yourself back with interest. You're recapturing the interest that would have gone to a third-party lender, keeping it within your system. Number 2. Proper money management. This isn't for willy-nilly spending. You need sound financial habits and a clear understanding of your balance sheet. And number 3. Meticulous documentation. Just like a bank, you need records. Document your loans, your repayment schedules, and the purpose of the funds. This professionalizes the process and ensures accountability. This system gives you the tools for financial control, but true success comes when you wield those tools with discipline. For too long, the conventional path has been presented as the only path, a road where you are a passive participant, a passenger in your own financial journey, forcing your capital to work just one job at a time, subject to the whims of the market. But the banking blueprint tells a different story. It doesn't thrive on idle money. It thrives on velocity, on capital in perpetual motion. It's about turning a single asset into a tireless workhorse, generating multiple returns from that single, hard-working base, constantly building, never sleeping. The personal banking strategy is the vehicle for this critical transition. It's a fundamental shift in your relationship with money, from being a passive saver, hoping for the best, to becoming the active manager of your own financial system. You unlock the ability to do what was previously thought impossible, to deploy your capital for opportunities, for investments, for life, without ever interrupting its compounding growth. The bottleneck that limits traditional approaches is finally broken. The trade-off between growth and access is eliminated. By implementing this strategy with the discipline it requires, you make a profound declaration. You stop being just a component, a cog in someone else's banking system. This is more than a financial strategy. It is an act of financial sovereignty. You become the owner and operator of your own financial engine. You seize control of the cash flow in your life. You harness the full, beautiful, uninterrupted power of compound interest for yourself and your family. The power is now in your hands. It's time to activate your capital. It's time to own your financial future. Thanks for watching the entire video. If this was valuable, the best way to support the channel is to like, subscribe, and hit the bell so you don't miss what's next. To learn more about building your own personal bank, check out the resources in the description. We appreciate you being here.